We are sold a comfortable lie. Go to school, climb the ladder, save 10% in a 401k, and retire at 65. But while you are trading your precious decades for a steady paycheck, an invisible financial architecture is quietly inflating your expenses right alongside your income, ensuring that the finish line keeps moving further away the closer you get. Here's the part that should really bother you. You've probably assumed the safe version of this plan is the one where your employer handles it for you. A pension, a guarantee, a promise stamped in HR paperwork that says no matter what happens, this money will be there. So ask yourself something uncomfortable. What happens when the company holding that promise simply doesn't have the money to keep it? That's not a hypothetical. It already happened, in plain sight, to one of the most trusted names in American business. And almost nobody outside of finance ever heard the full story. Think about it like this for a second. If a friend told you, "Don't worry, I'll pay you back in 30 years," you'd probably want to know a few things first. Does this person have a steady income? Are they actually good with money? Will they even be around, financially speaking, 3 decades from now? Most people never ask their employer's pension plan those exact same questions, even though it's functionally the same IOU, just wearing a nicer suit. For most of the 20th century, General Electric wasn't just a company. It was the blueprint for corporate America, the training ground for CEOs, the stock every retirement fund wanted, the employer people thought of the way people now think of a government job. Work there for 30 years and GE would take care of you. That was the deal. By 2001, GE's pension plan wasn't just healthy. It was sitting on a surplus of roughly $15 billion, more money set aside than it actually needed to pay out to retirees. Think about that number for a second. $15 billion of cushion. That's not a company scraping by. That's a company that looked, on paper, financially bulletproof. Jack Welch, the CEO who built that era, was treated like a business god. Harvard case studies were written about him. Management books quoted him like scripture. And the pension fund was often cited as proof that GE simply knew how to manage money better than everyone else. A walking advertisement for the idea that a big enough, smart enough company could outinvest the market forever. That surplus wasn't an accident either. It was built on an assumption that GE's pension investments would keep compounding at the strong annual returns common in the late 1990s, roughly 9% a year across most big company pension funds at the time. On paper, that assumption looked completely reasonable. Almost every major company was making the same bet. Then the man who inherited that machine, Jeff Immelt, inherited something else along with it, a set of financial assumptions nobody had stress tested for what was coming next. Here's where the story takes a completely different turn. Fast forward to the end of 2018. The same pension system that had a $15 billion cushion under Welch was now underfunded by somewhere between roughly $22 and $27 billion, depending on which filing and which year-end snapshot you look at. Either way, it had become the largest corporate pension shortfall in America. That's not a small miss. That's a swing of $40 billion or more at a company that was supposed to be the gold standard of, "We've got this handled." So what actually happened in between? It wasn't one dramatic villain moment. It was something much quieter and honestly much scarier, because it's still happening at companies right now. GE's pension fund had assumed it would keep earning strong annual returns on its investments, the kind of returns that were common in the late 1990s. But from 2000 to 2018, the fund actually averaged closer to 5% a year, well below what the original math required. GE wasn't unusual here, by the way. Around that same period, roughly 8 in 10 large companies in the Russell 3000 with pension plans reported being underfunded too. Add in the 2008 financial crisis, some poorly timed portfolio decisions, falling interest rates that made future obligations look even bigger on paper, and years of a shrinking, less profitable GE trying to prop up an old economy promise. And the surplus didn't just shrink, it flipped completely upside down. Picture a bucket with a small, slow leak. For a while, if you keep pouring water in fast enough, you'd never even notice the leak exists. But the moment you pour in slightly less than before, the leak stops being invisible and the bucket starts emptying, sometimes for years, before anyone outside the room notices how low the water's actually gotten. That's roughly what happened inside GE's pension fund for the better part of 2 decades. But here's the part almost everyone misses when they hear pension. A pension isn't a vault with your name on a locked box inside it. It's a pool, a shared pool, invested in the market, run by assumptions about future returns that can simply turn out to be wrong. Your guarantee was never actually a guarantee of money. It was a guarantee of a promise, backed by whether the math behind it holds up decades later. There is a backstop, technically. A federal agency called the Pension Benefit Guaranty Corporation exists specifically to catch failed private pensions. But even that backstop only ensures benefits up to certain government-set limits, and it's funded by premiums from the same struggling pension system it's meant to protect, which is a bit like asking a lifeguard who's also drowning to keep everyone else afloat. By the end of 2018, GE's total pension obligations stretched across roughly 600,000 retirees, workers, and beneficiaries, an entire small city's worth of people, all trusting the same set of assumptions to hold up. In October 2019, under new CEO Larry Culp, GE made the call. It froze pension benefits for around 20,000 salaried U.S. employees, meaning their pensions stopped growing from that point forward. It froze supplementary pension benefits for roughly 700 employees who'd become executives before 2011. And it offered lump sum buyouts to about 100,000 former employees who hadn't started collecting their monthly checks yet. Essentially, take a smaller amount now, instead of waiting for the full amount later. The freeze took effect January 1st, 2021. Going forward, those 20,000 workers would be shifted onto a 401k style plan instead. The same kind of plan tens of millions of ordinary Americans already rely on. Here's the plain language version of what actually changed for them, because the terminology alone is enough to make anyone's eyes glaze over. Under the old pension, GE carried the risk. It promised a set monthly amount in retirement, and if the investments underperformed, that was GE's problem to fix, not yours. Under the new 401k style setup, you carry the risk. You contribute. The company might match some of it, and whatever the market does with that money, good years or bad, is now sitting on your shoulders, not the company's. That's not a scandal, by the way, and it's not unique to GE. It's simply the decades-long shift almost every major employer in America has already made, quietly, one company at a time. What makes GE's version so useful as a case study is the sheer size of the swing. From a $15 billion cushion to a multi-billion-dollar hole, at a company literally famous for financial discipline. This still doesn't explain the biggest question, though. Why does this matter to you, specifically if you've never worked at GE in your life? Because the entire episode is a live demonstration of a rule the wealthy operate by, and most employees never get taught. Here it is, plainly. The system works differently for people who own assets directly than it does for people who are owed a promise by someone else. A pension, no matter how well-intentioned, is a promise sitting on someone else's balance sheet. Your name is on it, but the money, the investment decisions, the assumptions about future returns, none of that is actually in your hands. You are, in a very real sense, a creditor waiting in line, hoping the company stays solvent long enough and honest enough to pay you decades from now. Compare that to how people who actually build durable wealth tend to operate. They don't primarily rely on someone else's institutional promise for their future. They own things directly, shares of businesses, real estate, ownership stakes, assets that sit on their own balance sheet, that they can see, value, and in most cases control or at least directly monitor. If the assumptions behind those assets turn out to be wrong, they find out in real time, not 30 years later in a headline. That's the asymmetry. It's not that wealthy people are smarter about money in some mystical way. It's that they've structured their financial life around direct ownership, while a huge number of everyday workers are still structured around a decades-long IOU from an employer, a pension fund, or a government program they've never once inspected the books on. Think of it like the difference between renting an apartment and owning the building. As a renter, you're trusting the landlord to keep the lights on, fix the roof, and honor the lease for as long as you're there. And if the landlord goes bankrupt, that's suddenly your emergency too, even though you never touched the mortgage. Owning the building is more work, sure, and it comes with its own risks. But at least you're the one who can see the roof, check the foundation, and know exactly how much water is actually in the bucket. A pension is renting your retirement. Direct ownership is buying the building. And to be clear here, because this matters, this isn't a call to panic about your 401k or your emergency fund, and it's definitely not financial advice telling you to go buy or sell anything. Short-term savings you might need in the next year or two should stay safe and liquid. Full stop. That's just sound math regardless of who you are. This is specifically about the mindset behind your long-term surplus, the money that isn't going anywhere for 20 or 30 years, and whether you understand who actually controls the assumptions behind it. Here's the moment where this really lands. Nobody at GE woke up one morning and decided to sabotage 20,000 people's retirements. It happened gradually, through interest rate assumptions, return projections, and years of nobody outside the finance department checking the math, which is exactly why it's so easy to miss in your own financial life too. The danger was never a villain. The danger was a promise nobody was independently verifying. If realizing your guaranteed retirement plan was never actually guaranteed, changes how you think about where your future money actually sits. Hit subscribe. We break down how the wealthy actually structure their money like this every week. So here's the reframe, for your own situation specifically. It's not about whether you have a pension, a 401k, or neither. It's about asking one question you've probably never asked out loud. Whose balance sheet is my future actually sitting on, and have I ever checked it? If the honest answer is I have no idea, that's not a failure on your part. Almost nobody is ever taught to ask that question in the first place. Which frankly is a little funny in a dark way, considering it's the single biggest financial question most people will ever face, and most people are more likely to have checked the return policy on a blender than the funding status of their own retirement plan. And notice something else here, because it matters just as much as the big lesson. None of this means you should drain your savings account tomorrow to go buy stock in something, and it definitely doesn't mean cash and emergency funds are somehow worthless. Short-term money you might need for a car repair, a medical bill, or a rough month at work should stay boring, safe, and easy to reach, regardless of how wealthy you are or want to become. This lesson is about your long-term surplus, specifically the money you genuinely won't touch for 20 or 30 years, and about noticing, honestly, whether that money is sitting inside assets you understand, or inside a promise you've simply never questioned, owning even a small amount of something directly. A share of a real business, a piece of real estate, an asset with your name actually on the deed, isn't about getting rich overnight. It's about making sure your future doesn't depend entirely on someone else's spreadsheet holding up for the next 30 years. That's really what separates how the wealthy think about time. They treat decades as something they control the terms of. Everyone else, more often than not, is handed a set of terms, told it's guaranteed, and quietly encouraged never to read the fine print. And to be fair to GE for a moment, the pension freeze wasn't the company abandoning its workers out of cruelty. Current retirees kept receiving their existing benefits, and the freeze only applied going forward. But that's exactly why this story is worth understanding rather than being angry about. Nobody here was a villain twirling a mustache. It was ordinary incentives, ordinary assumptions, and ordinary human inattention, compounding quietly for 20 years until the math simply ran out of room to hide. You don't need $15 billion sitting in a fund to start applying that lesson. You just need to know, this week, exactly whose promise your future is currently resting on, and whether you've ever actually asked to see the paperwork. And that question, about whose promise you're trusting, is about to get a lot more interesting. Because there's an entire industry built on convincing you that a piece of plastic in your wallet is helping you win, when the real money isn't coming from what you buy at all. Next time on James's Business Files, we open a new file on why airlines quietly make more money from the credit card in your pocket than from the plane ticket you just paid for.